Hey folks, welcome to Chapter 15, Using Management and Accounting Information. So this is going to really start our foray into information systems, accounting, and finance. And so over the next two chapters, we're going to learn more about information and how we utilize it. So let's get started. So first of all, information and risk. There is definitely a correlation between the two. And so to improve the decision-making process, it's really important that the information used by individuals and businesses are both relevant and timely. And so relevant meaning it's something that's going to help us make a decision, and timely in the fact that it's up-to-date information, and it's again relevant in that it's going to help us make specific decisions. And so the correlation is basically the less information you have, the more risk you're going to undertake in a business. The more information you have, the less risk you're going to undertake in a business. So it's pretty basic, but that's the correlation, and that's the relationship between risk and information. Again, every decision needs to be made based on data, based on information. So many times we often go with our gut, and it's not as sound is making that decision based on data and information. So the difference between data and information, data is just the numbers. Data is a numerical or verbal description that usually results from some sort of measurement. So data would be the number of phone calls that a salesperson made, or the net profit of an organization, or the expenses of an organization. The information is that data presented in a form that is useful for a specific purpose. So this is where, as analysts, you could potentially be looking at creating PowerPoint presentations with charts and graphs to better explain the data that you've gathered from a financial statement. And so the relationship between data and information is data is the numbers, information are those numbers being presented. Okay, so I think that's the most important aspect of that. Knowledge management, really we look at a couple of different things in this. A database basically is a single collection of data and information stored in one place, typically nowadays stored within the cloud. And so a perfect example of a database would be Workday, or an ERP system like PeopleSoft. Another one would be your Google Slides, that whole Google Cloud database where you keep a lot of your documents, a lot of your spreadsheets. That's a database. Knowledge management is a firm's procedures for actually generating, using, and sharing that data. Okay, so that's the knowledge management piece. So the database is the system in where we keep information and data, and the knowledge management is how we send it out throughout the company. MIS, you're going to have a section here in the next couple of weeks where you will actually learn more about information systems from another professor, a guest speaker that we have coming in to record, Mike Lee, and he is an amazing MIS professional, and so he put some videos together to really speak to this. But basically, MIS, or Management Information Systems, it's a system that provides managers and employees with information they need to perform their jobs. Basically, that's it. It's information that's housed securely, that people within an organization can extract to make decisions. The purpose of an MIS is to distribute timely and useful information for both internal and external sources, managers and employees who need it. Okay, so the MIS system is there to manage all the information that a company may have, and then disseminate that amongst its employees and its investors and its managers and the public potentially. Okay, and so that MIS system could be a bunch of different databases. It could be Workday, it could be PeopleSoft, all in one. So some companies have multiple databases that they use within their MIS structure, and so could be a Salesforce, and then they use these to create information to disseminate to different stakeholders. A firm's information requirements. Many firms are organized into 5 areas of management. We've talked about this a little, but let's reiterate what those are. Financial management, marketing management, operations management, HR management, and administrative management. Here's what they do and the requirements that they have for information. So, financial managers must ensure that a firm's managers, employees, lenders, and suppliers all have the information they need to manage the financial health of the company. Those are the financial statements, the income statement, the balance sheet, the statement of cash flows. Those are all the things that the finance managers handle. They make sure that all that information is timely and accurate. Operations managers are more concerned with future sales levels, inventory levels, availability of natural resources to make goods. The information that they have is specifically geared towards operating the company. Marketing managers, for them, it's all about understanding how their products and services are being offered, how it relates to what competitors are doing. The information they gather is a lot of times geared towards customers, what's driving customer buying behaviors. And so all that information is really important in terms of selling. Human resource managers, they're responsible for any information that relates to employees. Okay, that's why Workday, PeopleSoft, all of those ones are really specifically geared towards hiring. They're geared towards evaluating employees, stuff like that. And then overall, administrative managers are responsible for the management of the organization. So it's kind of a catch-all. Here's the 5 management functions of an IS system. So the IS system you collect data, you store data safely. There's companies out there that all they do is store data, and they store it securely. They update the data. That could be new employee lists. That could be new customer lists, new customer information. They process the data into information. So that means they extract it and they turn it into maybe a graph or a chart or a PowerPoint presentation. And then they present the information to users. Pretty basic. Why is accounting information so important? Basically, accounting is the process of systematically collecting and analyzing financial information of a company. It's important to be used to answer questions about what's happening in the past, but also what can we do in the future? Do we have enough money to do this merger? Do we have enough money to buy more raw materials? Right? What did our balance sheet look like a year ago as opposed to now? Accounting information, the health, the fiscal, financial health of a company is critical. And accounting makes sure that on a daily basis, we understand the financial health of a company. Okay? To improve the accuracy of firms' accounting information, financial statements, businesses rely on audits. So once a year, potentially even once a quarter, companies, independent auditors will come in and they will audit a company's financial statements to make sure that they're hitting all the requirements that they need to hit. This is what an audit is. It's an examination of a company's financial statements based on GAAP, generally accepted accounting principles. Those are the rules that accountants have to live by here in the United States, right? Especially if you're a publicly traded company monitored by the SEC, the Securities Exchange Commission, you have to follow GAAP. And so GAAP is basically all of the rules that pertain to accounting. To audit that, you're not necessarily auditing it for accuracy, you're auditing it for GAAP compliance. Okay, so companies like PricewaterhouseCoopers, Ernst & Young, Moss Adams, BDO Seidman, those are all public accounting firms that go in and audit companies' financial statements to ensure that they're meeting GAAP. And then they turn over those records to banks, they turn those records over to investors, they turn those records over to the SEC to make sure that they're following that rule. Different types of accountants. There are managerial accountants and financial accountants. Managerial accountants are financial analysts. They're the ones that actually utilize the accounting information to make decisions. And the financial accountants, those are the individuals that actually create the accountants. Those are your staff accountants, AP clerks, cost accountants. The managerial accountants, those are your senior financial analysts. Those are your budgeting analysts, mergers and acquisition analysts, private equity analysts. Okay, those are the people that analyze the information to help make decisions. These are the people that put out the information. Okay, and so if you're thinking about going to an accounting, one of those two potentially could fit what you're looking to do. Additional areas of accounting that you could get into would be cost accounting, tax accounting, government accounting, and even nonprofit accounting. Here's some other careers in accounting. You can go into public accounting or private accounting. Public accounting, again, is working for a public accounting firm like a BDO, a Moss, an Ernst & Young, a KPMG, going into organizations and auditing their financial statements for GAAP compliance. If you did that, you would probably become a CPA. You'd become a certified public accountant and go through one of the most rigorous accounting examinations, just examinations in general, there is. And so to become a CPA is a long journey, but it's also, as a career, it's extremely rewarding. You can do anything with a California CPA. Okay. And then private accounting, that's just going into a company and working as an accountant or a financial analyst within their organization. Here's the accounting equation. This is for the balance sheet. Assets, okay, equal liabilities plus owner's equity. Assets are resources a business owns. Liabilities are their debts, and owner's equity are what would be left for owners of assets where sold. Okay, so you take all your assets, that should equal all of your liabilities, all your debts, plus all of your equity. And what that looks like on the balance sheet is it's a summary of the dollar amounts of a firm's assets, liabilities, and owner equity accounts at the end of a specific accounting period. So like at the end of every month, at the end of every quarter, at the end of every year. The balance sheet must demonstrate that assets are equal to liabilities plus owner's equity, and the accounting equation is in balance. That's why they call it a balance sheet. You will learn much more about this in Accounting 201 or 2001. That's financial accounting. Here's what a balance sheet looks like. On one side, you've got all the assets. You've got current assets, fixed assets, intangible assets. All the assets equal here $340,000. I'm going to move my face up here. And then we have our liabilities, our current liabilities, our long-term liabilities, plus our stockholders' equity also equals the same, $340,000. So when we buy something with credit, that turns into a liability. So if we buy a piece of machinery for $10,000, we put that into a liability. We then also turn that into an asset. Now it's a $10,000 asset. So that $10,000 asset, we bookmark over here, and then the liability for paying it goes over here. Pretty easy. Again, assets on a balance sheet, assets are listed in order from the most liquid to the least liquid. Liquidity is basically the ease of transferring something into cash. Okay. Current assets are assets that can be converted quickly into cash that would be used in less than 1 year. Current liabilities are liabilities that will be paid within a year or less. Those are accounts payable, notes payable, salaries payable, and taxes. Long-term liabilities are debts that need to be repaid for at least 1 year. And then owner's equity for sole proprietorship, owner's equity is shown as the difference between assets and liabilities. For a corporation, the owner's equity is usually referred to as stockholder equity because it's a corporation. The income statement, it's a summary of a firm's revenues and expenses during a specific accounting period. Okay, for a business, the income statement looks like this. It's all revenues or sales minus cost of goods sold minus operating expenses equals net income. Revenues are the dollar amounts earned by a firm from selling goods, providing services, or performing business activities. So those are our sales. Our net income occurs when revenues exceed expenses. Our net loss occurs when expenses exceed revenues. This is what an income statement typically looks like. Here are our revenues, which are $450,000. Our cost of goods sold are $334,000, leaving us a gross profit of $117,000. Then we minus all of our operating expenses, which eventually takes us to our net income, which is $30,000. You're going to learn more about this again in accounting. The statement of cash flow is basically a statement that illustrates how the company's operating, investing, and financing activities affect their cash. Here's what a cash flow statement looks like. Again, you'll learn more about that in accounting. Lastly, financial ratios. The two big ones are profit margin or gross margin, return on sales, and that's basically you take net income divided by net sales and you get your return on sales. This basically just tells you how effective your sales techniques are, how effective your sales are as opposed to how much you're putting into it. So the return of sales indicates how effectively the firm is transforming sales into profits. And then the other big one is current ratio. How fast can we turn over our assets to cash? So a financial ratio computed by dividing current assets by current liabilities. A high current ratio indicates that a firm can pay its current liabilities. A low current ratio can be improved by repaying current liabilities, by reducing dividend payments to stockholders to increase the firm's cash balance. So financial ratios are really important to understand how a company is doing, right? You can take a snapshot and look exactly what's going on with an organization. That's accounting and information systems. So you'll learn more about that in the next week or so. And so it's important to understand that. And in terms of accounting, you'll learn more of that as once you get into Accounting 2001. So hope you enjoyed that riveting presentation on accounting. We will talk to you soon, and I hope you have a great day.